Welcome back to XRP Intel Authority, the channel that breaks down exactly what is moving your XRP and why. And today we need to have an honest conversation because things are not looking great out there right now. And we titled this one, "The Truth About XRP Finally Came Out," for a reason you are about to understand. Right now, XRP is sitting down more than 6%, and if you have been watching your portfolio today, you already know the pain we are talking about. What makes this particularly frustrating is that the broader stock market is actually up today, so on the surface it almost feels backwards. You would expect that if traditional markets are climbing, crypto should be following along in some kind of risk-on rally, but that is simply not what is happening right now, and we are going to walk through exactly why this disconnect is taking place, so you understand the real mechanics behind the move instead of just watching the red candles and feeling confused or anxious about what comes next. Let's zoom out for a second because XRP is not suffering alone here. The entire crypto market is under pressure today, with the overall market down somewhere around 4.5% to 5% across the board. Bitcoin is down roughly 5%, Ethereum is also down close to 5%, and some of the more volatile names are getting hit even harder, with Solana down over 7% and Hyperliquid down more than 11%. So when we say XRP is down 6+%, understand that this is not some isolated XRP specific weakness. This is a market-wide risk-off event, and XRP just happens to be moving along with everything else in this asset class. One detail worth pointing out before we get into the why is that trading volume on XRP is actually up around 30% today, which tells you this is not a quiet, low-conviction drift lower. There is real activity and real money moving through the order books right now, and that matters because it shows participants are actively reacting rather than simply sitting on the sidelines. Looking at the price action more closely, the 24-hour low on XRP has come in right around $1.13, and depending on exactly when you are watching this, price may be sitting right at or very close to that low as we speak. That is an important technical level to keep an eye on, because how price behaves around a recent low often tells you a lot about near-term sentiment. If buyers step in and defend that level, it can become a foundation for stabilization. If it breaks down further, it tends to invite even more selling pressure as stop losses get triggered and momentum traders pile on in the same direction. Either way, the level itself is not the real story today. The real story is what triggered this move in the first place, and that brings us directly to the Federal Reserve, because this entire sell-off traces back to a single source. And once you understand what happened there, the rest of this price action starts making a lot more sense. Yesterday, the Federal Reserve made its announcement, and on the surface it sounds almost boring because they simply decided to leave the federal funds rate unchanged. No rate hike, no rate cut, just a hold steady decision that on its own would not normally be enough to spark this kind of broad-based selling across crypto. The real issue is not the rate decision itself. The real issue is what came along with it, because the Fed also signaled that it is not going to be offering much in the way of forward-looking guidance about what it plans to do next. In other words, the market is being left without a clear roadmap, and markets generally hate that kind of ambiguity far more than they hate bad news that is at least clearly defined. When the Fed gives less clarity about future policy direction, traders and institutions are forced to price in a wider range of possible outcomes, and that uncertainty itself becomes a risk factor that gets reflected immediately in asset prices, especially in something as sensitive to liquidity conditions as crypto. Here is why that distinction matters so much for an asset like XRP specifically. Crypto as an asset class is extremely sensitive to monetary policy signals, probably more sensitive than almost any other major asset category out there. When the Federal Reserve is seen as accommodative, meaning they are cutting rates or signaling that cuts are coming, or when they are actively injecting liquidity into the financial system, that tends to be enormously bullish for crypto because cheap money and abundant liquidity naturally flow toward higher risk, higher reward assets looking for returns. On the flip side, when the Fed signals restriction, tightening, or even just stays vague and non-committal about reducing that restriction, capital tends to pull back from the riskiest corners of the market first, and crypto sits firmly in that category. So when the Fed essentially says, "We are holding steady, and we are not going to tell you much about what comes next," the market interprets that as a signal that the liquidity conditions crypto needs to thrive may not be improving anytime soon, and possibly could even tighten further from here. It is also worth pointing out how communication styles from the Federal Reserve have shifted over time, because this matters for how markets are reacting right now. In the past, Previous Fed chairs would come out and speak at length, and people would spend hours dissecting every single word, every pause, every shift in tone, trying to figure out whether the language leaned hawkish or dovish. Even then, a lot of that talking didn't actually reveal much substance. It was often more about managing expectations through tone rather than delivering hard commitments. But what we are seeing now feels like an even further step back from transparency, where the messaging itself is becoming more guarded and less forthcoming about future intentions. And when an already historically tight-lipped institution becomes even less communicative, that vacuum of information gets filled with speculation, fear, and defensive positioning. And that is exactly the kind of environment that produces broad-based selling across risk assets like we are seeing today. So really, what we are dealing with here boils down to one core problem: uncertainty. And uncertainty, especially when it is tied directly to the Federal Reserve and its relationship with crypto markets, almost always translates into downward price pressure in the short term. It is not that anyone necessarily believes something catastrophic is coming. It is simply that when the path forward becomes unclear, capital tends to de-risk first and ask questions later. Layer on top of that the simple structural reality that we do not have a lot of fresh liquidity flowing into these markets right now anyway, and you end up with a situation where every time bears get an opportunity to push prices lower, they take it, because shorting into thin liquidity with limited buying pressure pushing back is one of the easier trades available in this kind of environment. This is not a new phenomenon either. We have talked about this dynamic before, and it lines up with what a lot of us have been saying for a while now, which is that getting through the summer months is going to require patience, because thinner liquidity conditions during this stretch of the year tend to amplify both the downside moves and the eventual upside moves once fresh capital does return. That brings us to the bigger picture question everyone wants answered, which is, when does this actually turn around? The honest answer is that we need real liquidity injections coming back into crypto, meaning genuinely new capital and new buying interest entering the space, not just existing holders shuffling positions around between each other. That kind of bullish capital inflow is what eventually pushes things higher in a sustainable way, and right now, with the Fed signaling caution and limited forward guidance, that fresh wave of capital does not appear to be arriving immediately. But here is the important distinction to make, and it is one worth repeating clearly. This is a near-term liquidity and sentiment issue, not a fundamental breakdown in the long-term thesis for XRP or crypto more broadly. Markets move in cycles, liquidity conditions shift, and Federal Reserve policy stances evolve over time as new economic data comes in. None of what we are seeing today changes the underlying utility case, the adoption trajectory, or the long-term outlook that so many of us have been building positions around for years now. On a personal note, before we get further into today's update, we want to be transparent about something. There was no upload yesterday, and that was simply because travel got in the way. We were out in Maryland at a national lacrosse tournament watching our son compete, and the internet connection at the venue was honestly not reliable enough to put together a proper update for you. We always want to be upfront with this community rather than just disappearing without explanation, because consistency and honesty are things we take seriously here. The good news is we are flying back to Dallas today, and things will be back to normal operating schedule starting tomorrow, with our regular daily updates resuming as usual. We mention this not because it changes anything about the market analysis, but because we know a lot of you check in daily expecting these updates, and we never want you wondering if something is wrong when really it is just a scheduling hiccup tied to family life and travel logistics that happens from time to time running a channel like this. Stepping back to wrap up the core market picture, the takeaway here is straightforward, even if the underlying mechanics are a little more nuanced than a single headline could capture. XRP being down over 6% today is fundamentally a Federal Reserve-driven event, layered on top of already thin market liquidity, layered on top of a broader risk-off mood spreading across the entire crypto market simultaneously. This is not about some XRP-specific bad news or fundamental deterioration in the project itself. It is a macro liquidity and monetary policy story playing out across every major digital asset at the same time. And XRP is simply caught in that same current along with Bitcoin, Ethereum, Solana, and virtually everything else in the space. Understanding that distinction matters because it changes how you think about today's move. This is not a reason to panic about XRP's fundamentals. It is a reminder that macro conditions, especially anything tied to the Fed, can move markets in the short term regardless of how strong the underlying asset's long-term story actually is. Now, before we let you go today, we do want to take a moment to talk about something that could genuinely help put some of that existing money you already have to better use, especially during a period like this where patience and smart positioning matter more than ever. If you already have an existing IRA or Roth account sitting somewhere, possibly earning a modest 2, 3, or 4% return through a traditional manager, there is an option worth considering through our partner, iTrust Capital, and the links for this are available in the description below. We formed this partnership because we genuinely believe in what this company offers, and the flexibility here is worth understanding. You can transfer an existing retirement account directly into iTrust Capital and use those funds to gain exposure to crypto, gold, or silver, all within that same tax-advantaged retirement structure rather than starting completely from scratch. For anyone who does not already have an account to transfer, there is also the option to open a brand new Roth IRA directly through iTrust Capital. And the tax advantages here are honestly significant enough that they are worth walking through with a clear example. Imagine you took $10,000 and grew it by $50,000 in capital gains by investing in crypto through a regular taxable exchange account. In that scenario, you would likely owe somewhere around $7,500 in capital gains taxes on those profits. Now imagine that same $10,000, that same $50,000 gain, but this time it happened inside a Roth IRA through iTrust Capital instead. In that structure, you would owe $0 in taxes on those gains, completely legally, simply because of how Roth accounts are treated under current tax law. That is an enormous difference in outcome for the exact same investment performance, and it is exactly why we wanted to make sure you were aware of this option. We genuinely respect what iTrust Capital is building, and we appreciate the service they provide by making it straightforward for everyday investors to access crypto, gold, and silver inside a properly structured, tax-advantaged retirement account rather than leaving that opportunity on the table. If that sounds like something worth exploring for your own financial situation, the links are right there in the description below this video, and we would encourage you to take a few minutes to go check it out for yourself. As always, we will be back with you tomorrow once we are back home and settled in Dallas, continuing to track exactly what is moving XRP and the broader crypto market day by day, because that is what this channel is here for. Make sure you are subscribed to XRP Intel Authority so you never miss an update. Drop a comment letting us know how you are navigating this pullback, and we will see you in the next one.